Welcome back to Your World at 10. Now, on this day, 1 year ago, the S&P 500 hit a 12-year low of 672. In the 1 year since, it has rallied 70%. In the same year, the Sensex has rallied 112% from a low of 8,047. While the crash of 2008 was unprecedented, the rally since March 2009 seems to be no less remarkable. Does this run justify where the global economy stands just a year or two after the meltdown? Will trouble in Europe take us back to the days when banks in the US were going down like dominoes? Well, joining us to reminisce over the last 1 year and look into the future of these markets, market veteran Ramesh Tamani. Ramesh, thank you so much for your time. Thank you for joining us tonight. What a year it's been from where we were on March 9th last year to where we are today, not just in India but across global markets. What do you make of it?
You're right, Manika. I mean, it actually was a near-death experience for financial markets last night. I remember it so vividly. It seemed like the bloodletting, the price falling would never stop, and it's truly been astounding, how much the market has rallied since then, and how much bluster has come back into the market, whether it's in terms of price appreciation, whether it's in terms of bonuses given to employees, or this, feeling that no matter what happens, we're okay. You're right. It's been two complete opposite ends of the spectrum, near death and near normalcy. The thing, of course, though I'm reminded, Manika, is what Mark Twain once said, is that what we learn from history is that we never learn from history.
Well, Ramesh, tell me if these market levels are justified anywhere else in the world. For instance, if I was to draw a very simplistic comparison, right, the Sensex is up over 100%. Do you think that the underlying economic fundamentals have improved over 100% from where they were in March last year? Or have we gotten ahead of ourselves in these markets? Is it a case of extreme, sort of exuberance as compared to extreme fear and nervousness last year? What do you make of where we stand today and where this takes us next 12 months down the line?
Interesting question, Manika, and for once I will isolate India out. I don't want to answer the question being center of the universe. I want to take India out. And the first thing you have to understand is what is happening in the US markets, because those still are the primary markets that this thing. And what has happened there is that the US government has created a great moral hazard. And the principle that everyone in the West or Europe or other markets know is that no matter what happens, there's a textbook template on how to handle a crisis. You open the gates of monetary policy, flood the market with money, lower interest rates out there, give the financial markets a case of steroids, markets will jump back, and everything will be okay. And that's like saying that you're going to have religion or you're going to have a Bible without heaven and hell. It's like in capitalism, you won't have reward or failures or punishment or bankruptcy. I mean, it seems almost too good to be true that the worst single crisis we've seen since the Great Depression could be over by just opening up the money spigots. Now that has created a moral hazard, and somewhere down the road, the economies of the West are, in my opinion, going to pay a price for that. It's very ample clear to me. You just cannot paper over the problems. There are definite problems of their society in terms of rising costs, lower exports, great current account deficits that need to be addressed with some hard economic decisions, which I don't see happening. All the Fed has done successfully is to open the money taps. To come back to your question about India, I think actually we've escaped the bullet because we never really had the kind of crazy inflated values that the Western societies had. There were excesses in our stock market, which the correction took care of. So fortunately for us, India seems to be on a level path. Is the gains justified in India from the bottom 112% gain? In many ways, I think yes, because you go back and look at the raw data numbers, whether it's automobile sales, whether it's cement shipments, they're all very strong. The index is not trading at any lofty multiple, but maybe 15 or 16 times earnings. So India case is justified. Globally, all around me, I just see huge amounts of moral hazard.
And how is that moral hazard likely to sort of impact India, Ramesh, down the line? I understand that, on our own, we seem to be far better off, as you've drawn out, in contrast to what some of the Western economies are going through. But this sovereign debt problem overhang, and if at all it goes from just being an overhang to being an actual crisis, can we escape the worst of it? I recall very sharply right now the comments that Samir Arora was making right after the budget speech, where he said that we're being a little too sanguine about the kind of impact that could chance upon India, just like we were being, a little too sanguine just before the Lehman bust happened, or we kept talking about decoupling and we couldn't escape the implications of that crisis. What will happen to India if we actually see one of these sovereign debt problems turn into a crisis?
Menika, there's no doubt that if we have a sovereign debt crisis, the first leg of the fall will be down. There's no question about that. It will be led by Hang Seng as it is usually in emerging markets. And India will follow suit, followed by Singapore, Taiwan, Bangladesh, whatever have you. But the point here is that, as they say, growth covers a multitude of sins. If your inherent economy is growing at 8.5%, as you're projecting, there's reason to believe you'll do that over the next 2-3 years, 8 to 8.5%. That covers for a lot of sins, a lot of excesses that take place in the market. And there is some historical example. Let's go back to the glory years when Japan was growing at 8-9% double-digit rates. And we had a great crash in the US when the markets fell 27%, 22.5% actually in a single trading session. The Japanese market fell along with the US market in sympathy, but recovered right away because the inherent strength of the Japanese economy. We might see a similar situation unfold out here. I mean, the RBI has done a great job, as everyone knows out there. Asset prices, except for a few isolated cases of real estate, are in line. There is reason to believe that we will be able to decouple, notwithstanding what the cynics say.
What will it do in terms of appetite for emerging markets when it comes to foreign investment money? Ramesh, we've had, I'm told by one figure, roughly $20 billion come into the cash markets in the last 1 year. This is FII money that I'm referring to. A lot of it also going into support some of the corporate fundraising activity that we've seen in the course of the last 1 year. If we see an explosion of that sovereign debt crisis of any sort, how is it going to impact FII inflow? And therefore, can it have longer-term implications for us?
It's very hard to diagnose that because typically when we've had this crisis, there's a flight to the dollar because people believe that the dollar is still a sounder currency than putting your money elsewhere in the world. But at some point, the poor fundamentals of the dollar will take over. So you'll see a spillover into other asset markets, hard asset markets, like gold or metals, if you will. But at the end of the day, investors want to return, and they don't want necessarily get that in gold. They want to return in equities, a dividend in equities, a price appreciation. Money will come back to emerging markets if that growth is pure and that growth is, pegged at, say maybe 2 times GDP growth. Money will come back. I mean, ultimately, money chases growth the world over. So I think if we just do our, correct policies in-house, we take care of our fiscal problems, we take care of our, Naxalite problems, I think India could be a shining example for the next few years of money flowing in and good productive growth for years to come.
Ramesh, global factors aside, from a local point of view, what are some of the challenges that you put down as key challenges when you invest or trade in this market?
The challenge is always the same, Menika. You want to look for value at 16, 17,000. It gets no easier to find value. But, all bull markets begin with some sort of intellectual theorem. You have to believe in some sort of hypothesis. Let's say in the 92 bull market, hypothesized that India was going to be a liberalized country. And that's what exactly happened a decade later. The 2000 bull market foresaw that India was a technological superpower. Bingo, it came out right. What is this bull market telling you? This bull market telling you that something extraordinary is happening in this country. That we are going to go from a nation of 50 million middle class to about 500 million middle class in a period of 10 years. Now, if you believe that intellectual hypothesis, if you believe that we're creating a brick country with 500 million consuming Indians, suddenly the investment paradigms become very simple. You want to invest in domestic consumption. You want to invest in entertainment, in housing, in two-wheelers, autos, cement, because all these things are going to be in great demand once that middle class surges up to 500. And if you think you track the auto numbers, as some of my friends do, that's just a trailer of what's happening. Demand is so strong that we're backlogged in automobiles for 3 months, 6 months. That is going to percolate to other sectors of the economy, be it housing, be it entertainment, be it two-wheelers, be it consumer durables. So I think, the trick is sometimes you tend to look at a quarterly earnings or one bad fall in global markets and tend to panic. But maybe sometimes you want to take a longer view. Maybe the winner in this market will not be the person who passes the pillow, but one who holds the pillow till the end.
Holds the pillow till the end. You sound very bullish, Ramesh. Is there nothing that you worry about? Let's say, where would you think that this market would be March 9th, 2011? Peter Lynch said, if you want to spend 10 minutes on a conversation, you spend 10 seconds on predicting where the market is going. Really, nobody knows, Menika. I'm not that smart enough. But my sense is the undertone is buoyant in India. The stocks are looking good. The corporate outlook is good. If you go and meet managements in corporate India, everyone is buoyant. Everyone is talking about expansion. They're not talking of degrowth. They're talking of growth. So it's a good time to remain invested. I mean, bull markets will have corrections. Maybe one will start tomorrow. Maybe one will start next week. You just have to ride the pain. But look at the broader picture. Look at the belief that we're going to have a country that's changed in about
10 years' time or 15 years' time. And it's like investing in America in the 1950s. You want to hold on despite wars, the Korean War, Vietnam War, Watergate, any number of events that took place in America. The winners were people who held on to the Johnson & Johnsons and the IBMs. So maybe we're in a similar trajectory in history. It seems to me that the risk-reward still favors the buyer.
Do you think that this bullishness has sort of crept down to the retail investor level as well, Ramesh?
Not entirely. I think they've become more of traders, in and out of market. Everyone wants to sell out on a Friday in case something happens over the weekend crisis. I think in that opinion, what I have a strong opinion about is this is what the government should do. The government should have a full-fledged policy to disinvest PSUs among retail investors. They should hire someone from the telecom guys who took penetration rates of telecom from 1 per 100 to 50 per 100 and say, I want to get the Indian public excited about PSU stocks. There's some great companies, I'm going to offer them some great valuations. And if they do that, they'll build a whole equity cult around this country. And that's what the government can do. It's essentially taking taxpayer money, building these assets, now returning it back to the taxpayer in terms of stock certificates. I think if they do that, we'll see a huge retail surge in India, Menika.
Well, Ramesh, going by the last few public sector issues, that's a long way coming. But thank you very much for sharing your views with us on what the last 12 months of a market journey has been like and where we could likely be next March. Sorry to put you on the spot for that. Well, that was Ramesh Damani. We need to take a quick break on Your World.